All right. Hey guys, it's Jonathan Schulteis here, and I've got John Doyle and Dan Jess from American Funds with me today. And I know a lot of our plan sponsors, we use American Funds in several of our plans, and American Funds is one of our 338 options. So I'm excited to have John and Dan with me today, and I appreciate you guys being able to meet remotely, as I know everybody's practicing the social distancing that's going on today. So I've asked Dan to join us, and Dan, why don't you kind of start us off a little bit with, maybe a little bit about what you guys are seeing in the market, and talk maybe briefly on the target date funds.
That's great. Thank you, Jonathan. Thank you to everyone who's here with us today. Appreciate the trust in the American Funds. And obviously our thoughts are with families and people who are affected by this. You see in the background there, Rob Lovelace on what a recovery could look like. That's on our landing page. It's through Capital Ideas, which is our up-to-minute thinking from our portfolio managers and analysts. And I think that visual is really good there, right? You see a hiker who can see the other side of the mountain. There's a valley in between. There's no doubt about it, we're in the valley right now, but we can certainly see the other side because we had a really strong, a really healthy economy, albeit probably late cycle if you go back to the beginning of the year. But we know we had strong fundamentals within our economy, and then we were hit with this really terrible outbreak of a virus. In American Funds Capital Group, we really are kind of built for this type of an event. So, and I'll reference our target date investments from, how we were able to respond during this crisis in protecting folks. But if you look at our fixed income investments have done extremely well because we really do build those fixed income funds in the target date series to be the airbag within your portfolio when markets go down or correct. So we want to have something that's positive in your portfolio when stocks are down. And there's no question about it right now, stocks are down. Good stocks, not so good stocks, mediocre stocks, bad stocks are all down in lockstep. And that's where that visual of seeing the other side at American Funds is really what we're focusing on right now for you as clients. And I can share with you, Rob Lovelace, who's been a portfolio manager for 34 years, he said right now we have 5 times the buy recommendations on the analyst calls right now that we do sell recommendations. Because if you look back for bear markets going back to 1900, the average decline with the recession is about 31, 32%. And as of the last few days and even weeks, we've been really right around that 31 to 34% trough. And so not calling that that's the bottom, but we're certainly, the market is trying to find a bottom. And what we want to be able to do through research is identify those companies that 18 months from now, 2 years from now, are really well positioned to deliver returns. At the same time, being cognizant if we're going to be in the valley for the next 3 to 6 months, as some bad economic data will come out from this shutdown, that we're also investing in companies that will protect you while we're in the valley, but looking out 3 to 5 years, that's why you hire us as active managers to find the very best opportunities. Jonathan, did you want me to go deeper on any of those?
No, I think that's awesome. I mean, the fact that you said you have 5 times the buying recommendations versus selling, that's definitely some positive news. We had a pretty good day in the market today, so hopefully we're seeing things kind of bottom out and start to turn around. So that's pretty cool. Hey, John, I wanted to kind of go to you for a second. I know you kind of working at the national level, you get the opportunity to kind of get your thumb on the pulse of what other plan sponsors are thinking out there. Why don't you share with us a second kind of what you're seeing from other groups?
So it's kind of interesting because I think that, often when we start the conversation with the plan sponsor, we're kind of expecting to have to focus just on the investments because of what's been going on in the markets. But what's concerning a lot of the plan sponsors that I've talked to is more their participants, and what should they be doing with their employees? What should they be doing with their participants in the plan? And what are other companies or plans doing as well? So, one of the things that we've kind of had an opportunity to help them with is just an understanding of, as a plan sponsor, what's your message out to your participants? Are you being clear in the kind of long-term investing nature of a 401k or defined contribution plan? And is that message resonating with participants? So that seems to be probably the number one concern that I've heard when it comes to the plan itself, where the investments are fine. There's a lot of work that everyone's done to try to put good investments that will weather this type of storm. But what are they doing? What are participants doing that really they can impact and influence right now? So I think we're kind of doing the same thing as we're kind of looking at it. We're addressing those questions, and then we're looking at what are the participants doing. So what's the behavior been like? And I went back and looked at a couple of studies that had just come out that were put together by some record keepers. And one of the headlines I read said something along the lines of participant activity is up 12 times. So it's 12 times as active as it is on a normal market day. And I think that was somewhat concerning, because I think it implied that participants are doing a lot of trading and probably selling out of the market. But actually, if you look deeper into the numbers, you found out that, well, a normal trading day was probably 0.03% or 0.3% of participants would actually do anything. And the spike got up to slightly below 2%. So you're still talking about a very small portion of participants that are actually going in and doing anything. And most of those are doing it because they are managing their own portfolio. They're not in the QDIA. They're not in a professionally managed portfolio. So as far as I can tell, and they're kind of raw numbers and anecdotal to a certain extent, it seems that most participants are riding it out as we've told them to. It's a long-term investment. And those that are in the QDIA are pretty much staying there. And even looking at our funds at the American Funds target date, looking at the cash flows are all still net positive. There are some exceptions in the years in retirement where we're probably not seeing the contributions going in, because, for example, the 2015 fund, people are likely retired if they're in that as a 65 or 70-year-old, and they should be drawing money out to provide income, which is what the target dates are designed to do. So I think that the behavior we're seeing from participants is almost exactly what we want to see, is stay the course, take advantage of the lower market through dollar cost averaging with your contributions, and don't make any rash decisions. And they seem to be doing that.
So let me ask you this: when you say what's your message, and my question is, how are plan sponsors getting that message out? Because typically one of the things that we do at Gate City Advisors is we're really big on employee education. And with social distancing and a lot of companies not having employees on site, it's really made us get real creative at how we do participant education. And so are you seeing things out there that maybe some plan sponsors are being creative in how they're getting a message out and how they're continuing to do employee education?
Yeah, I think that's a great question. And I'm kind of curious to see, when this is all over, what it looks like in terms of the adoption of electronic communications and webinars to participants. Because, obviously this is something that we've been driving for a number of years, but getting participants to go online and attend webinars has always been difficult. Now that most of the social distancing is causing a lot of folks to work from home, or having more time at home in front of a computer, I would expect, and I don't have any data to say this is what's happening yet, but I would expect that they'll be more willing to sign up for and adjust to electronic communications and webinars. And we may actually see a significant uptick in usage going forward. I think that's what people are trying to do now, but I think the jury's out as to whether whether it will work and whether participants will actually go online and kind of read what's sent to them or participate in webinars.
Interesting. Yeah, I think it could change up. We actually did our very first participant webinar last week. So it's kind of interesting to see how this changes. Matter of fact, we've had plan sponsors who have asked us to do webinars on market volatility and things. And the cool part about webinars is they can be recorded and watched again later. So
Yep.
I think you'll see a lot of innovation through this, and that'll be exciting to see. So one of the things I want to ask you too is, what should committees be thinking looking forward, right? So what kind of things should be on committees' minds as we look forward through kind of where we are?
So I was kind of thinking about this the other day because, we always talk about committees making sure that they have a process, and that part of that process is documentation and making sure that the decisions that are being made are documented, they're kind of appropriate and take the participants' best interests into account. Now we have a situation where we've got kind of crazy markets right now. We have a lot going on in the economy, or actually not going on in the economy because of the coronavirus. And so one of the things in talking to some of the plan sponsors is the idea of making sure that their ducks are lined up for this crisis situation, and having a kind of supplemental meeting, maybe an off-schedule meeting, to talk about what they should be doing, if anything, around communicating with participants and making sure participants aren't making bad decisions or emotional decisions. And I think with everyone getting used to virtual meetings, it's probably not that hard to pull together a quick half-hour short meeting with the committee just focused on this one item. Is, okay, short term, are we doing the right things for participants, and making sure they're documenting it so that it's on the record that they are paying attention to the short-term issues that the crisis might be causing. That seems to be one of the best ideas. And then out of that, I think there are also two other things that they should look at, which is kind of a what-if scenario. So, if the regulators provide some sort of relief, what would the plan sponsor want to do? If there's a loosening up of hardship rules, for example, what's that going to mean to the plan, and what does the plan sponsor have to do? I think at least walking through the what if scenarios will better set up sponsors for any changes that they may want to or need to make once it's clear what the regulators will allow them to do.
I think that's a good point. I think it would make a lot of sense to do that and get the message together. So I really appreciate you guys taking the time today. I've actually got a page of notes here just from our conversation. So, hey, in closing, is there anything that maybe I forgot to ask you guys that you think would be worth bringing up, or maybe, maybe Dan, from you, is there something you'd like to just say to participants that says, a word of encouragement or anything else before we go?
Yeah, I would say that there's a quote that Rob shared on our call. It was, all market declines are temporary unless you choose to make them permanent. Mm-hmm. And really, we're all focused on participant outcomes here. And staying invested, staying the course allows us at Capital Group to deploy the cash that we've raised in portfolios to rebalance and to make the right investments for your future. And, whether you're 20 and just joining the plan, or if you're in your 50s or 60s, you think about it, you still have a long way to go, God willing, right? A lot of folks are living 30 to 40 years into retirement, and just help you make good decisions for 5 or 10 years down the road, because we will get through this valley.
Absolutely. I like that. I'm going to use that. That was pretty good. Anything from you, John, before we hop off here?
No, I mean, it can't emphasize enough the participant behavior, and, making emotional decisions can really hurt your long-term performance, because then you end up missing out. You never know when, if you make a short-term decision, you don't know when to change it and move back into the market. It's better to ride it out. And I think that's consistent with what Dan has said and what we've talked about here today.
Yeah, not trying to time the market, right?
Yeah.
Yeah. Well, guys, hey, listen, I really appreciate you taking the time to jump on a call with me today. This has been super helpful, and I'm sure a lot of our clients will really enjoy this this replay. So, hey, thanks again.
Thanks, Jonathan.
Thanks, John.